Welcome to another video lesson from sketchnest.com. In this lesson we will be talking about piggyback mortgage loans in general and the 80-10-10 mortgage loan in particular. So what is a piggyback mortgage loan and what does it have to do with you as a home buyer? As the name implies, a piggyback mortgage loan is a combination of two mortgages that are used to pay for a home. The first mortgage covers 80% of the mortgage loan. The home buyer then gets a second mortgage loan that covers 10% of the home's purchase amount, and the remaining 10% is covered by a down payment. So this is money that the home buyer puts up out of pocket in the form of a down payment. So we have the first mortgage for 80% of the purchase price, a second mortgage that covers another 10%, together those are 90% of the purchase price, and then the home buyer makes a down payment of 10%. And when you add all these things up, you can obviously do the math. It's pretty simple. You have 100% of the purchase price covered by the piggyback mortgage loan, in this case the 80-10-10. Now, what is the purpose of a piggyback mortgage loan? Why would somebody go to all this trouble to pay for a house? And the key concept here is mortgage insurance, or private mortgage insurance, also known as PMI. If you have a single loan, like this is a single loan, this is a single loan, if you have a single mortgage loan that accounts for more than 80% of the purchase price, in other words, it has a loan to value ratio higher than 80%, you will have to pay private mortgage insurance, or PMI, on top of your mortgage loan. This adds maybe another $75 to $100 a month that you would have to pay in order to get that mortgage loan. That's just the way it is. If a single lender loans you more than 80% of the property's value, you have to have mortgage insurance. So this is a strategy where this one is 80% of the mortgage, so it does not exceed the 80% that we talked about. This one is only 10%, so it obviously doesn't bring private mortgage insurance into the table, and the borrower makes a down payment of 10%. That is why people use the piggyback mortgage loans. That is how they work. There are different versions of them, so you can also have an 80-15-5 piggyback loan. This is where the first mortgage covers 80% of the loan, of the purchase amount. The second mortgage covers 15%, and the borrower makes a down payment of 5%. The other question you must ask yourself if you're planning to use this strategy is, which one costs more money over the long term? Is it cheaper, in other words, is it cheaper for you to take out a mortgage for more than 80% of the purchase amount and pay private mortgage insurance on top of that? Or is it cheaper for you to use the piggyback mortgage loan strategy? So we'll call this PMI versus piggyback. This is going to depend on the type of loan you're using, the amount of down payment, the interest rate you get on the loan. So there's no way that we can answer this question for you here. But the purpose of this video is to explain how an 80-10-10 piggyback loan works, or an 80-15-5. What you can do is you can go online and look for a piggyback loan calculator or a second mortgage calculator. They go by different names. And you can figure out, once you know how much you're going to borrow, what kind of interest rate you're going to get, you can see which one is the cheaper option. Whether it's cheaper for you to get a single loan that's greater than 80%, including PMI, or if it's cheaper for you to do a piggyback loan strategy and avoid PMI. It works out different ways, so you have to find out which one is in your best interest. That is how a piggyback mortgage loan scenario works. If you would like to watch more videos like this one, you can visit us online at sketchnest.com.